Hello, everyone. So, today we are going to talk about why it is time to get serious about investing. Now, this topic was inspired by a video that I saw on Instagram where there was a man that was being interviewed, and he was basically making a comment saying, "Are you in this for the long term, or are you going to let this short term noise get in the way of you being an investor?" And I thought it was a very telling comment in that there's been a lot going on in the last, I would say, 5 to 6 months, especially with the new administration. And the stock market has, of course, responded accordingly, especially around the tariff topic and tariff conversation. And so the market has dropped significantly in the last 5 to 6 months. In the last week or two, it has slowly began to rebound. But in this last 5 to 6 months, people have been panicking. They have been panic selling, and there's been a lot of negative sentiment around the stock market. And so when we have times like this where there's actually a lot going on. So one, we have the new administration, we have this ongoing tariff conversation that's impacting the stock market. We also have an economy that is also struggling. We have unemployment becoming rampant. Companies are laying off employees left and right, with many more to come. Businesses are struggling in regards to revenue and profitability. And then we have inflation, which has really made life super expensive, making it hard for people to afford their everyday expenses. And of course, all of this impacts the stock market. And so when we have times like these, people tend to panic. They are panic selling. So any investments they have, they want to sell those investments because they've lost money and they don't want to lose any additional money. That's usually the mindset that goes behind that. Or they're selling because they need the cash, right? They're unable to meet their everyday expenses. So they're trying to find ways to meet those needs. So if they have that 401k, an IRA, or any other investment account, they're going to liquidate those assets to then use those funds to afford their everyday expenses. And so with all of that, the stock market isn't doing too hot. But for those people who are serious about investing, you can't let this noise kind of get in the way of you continuing on your investment journey. And if you are someone who has been kind of playing around with the idea of getting into investing, but you're making like a million and one excuses as to why you haven't started yet, now this is your sign you need to start. Now, I find that with many people, the reasons why they don't start tend to be as follows. One, they're not sure where to start, to be frank, right? They also have this like analysis paralysis where they're trying to one day miraculously come up with this idea of how they're going to start, but they never actually take the time to do the research to get started. So they kind of have this made up timeline. Well, when I finally figure this out, or I can kind of learn a bit more, that's when I'll start. Or others, they just can't start financially because they have other responsibilities, or they have other financial focuses that are more important than investing right now. So this last one, I get that one makes more sense. If there are other parts of your financial house that you're working on, then investing might need to be on pause for right now. But investing is going to be crucial to your financial well-being, your financial well-being, your financial future, and your financial security. So truthfully, you can't afford not to invest, if that makes sense. So we're going to talk about how you can start this process today so you can finally commit and get things started. We can stop with the excuses. And the one thing with investing, sometimes you have to start before you're ready, right? And we can kind of translate this to many aspects of our lives, whether it's starting a new career, a new business, moving to a new city, right? There's so many things this can be relevant to start before you're ready. Sometimes you have to figure it out as you are going along. So let's just start with tip number one. The first thing you need to do is, I kind of already alluded to it, you have to commit to the process. Once you have decided you're going to start investing, you have to commit. It can't be something that you play around with sometimes, you put it on pause, you pick it up again. You really and truly have to commit, and you have to be willing to stick with this for the long haul. And now, when I say commit, that also includes writing things out when things are bad. I find that when it comes to investing, people tend to only want to invest when the market is hot, when the market is doing well. So, in times like right now, or if you go back to 2020 during COVID, people were running from the stock market. They were avoiding it like the plague. They were, again, panic selling for a number of reasons as well. Some are valid, some were not. But truthfully, when the market is not doing so hot, that is really the time you should be investing more. But I know that kind of feels counterintuitive, because if the market's not doing well, you're losing money. And the fear is you might lose more. And truthfully, you might. But what goes down must come back up. And if you look at the trends and history of any market, whether it's the S&P 500, the Dow Jones, the Nasdaq, what have you, you will see that those markets have these ebbs and flows, right? You'll see these waves where it goes up, it goes down. But what you will also see with this fluctuation is the trend overall is a general increase. Now, it doesn't increase straight up, right? It has these ebbs as it's beginning to increase. And so once you look at these trends, that while I can't give you an exact prediction of the future, it can give you an idea of what you can expect. And the thing with the dips, we don't know how long they're going to last, but also the peaks, we don't know how long those are going to last either. And that's the tricky part when it comes to investing. But that's also why you have to, again, commit to the process and be willing to write it out for the long haul. So let's get back to today's conversation. Well, the lesson at hand. So it is time to get serious about investing. So, step one, you are going to sit down and see or figure out how much can you realistically invest. Keyword is realistic. I find that with many financial goals, we tend to overcommit and under deliver. So we want to avoid that when it comes to investing, more so because there are tax implications when you are selling your investment. So I'm going to kind of use the example of saving. So how many of us have started on this savings plan? We're trying to build this emergency fund where you're putting money in, you're taking some money out. You're putting more money in, taking some money out, and you have this ebb and flow. And you have a hard time building up your savings balance because of that. That is usually because you're overcommitting how much you can actually save. Now, when it comes to your savings, it's really no harm, no foul, because there's no tax implication there. Whatever you put in, you can take out, no problems. You're just earning less interest if there's less money in the account. But when it comes to your investments, whenever you sell, whether you sell at a loss or at a profit, that is now a taxable event. And so you will end up having to, it's going to end up impacting your tax return when you do higher taxes for the following year. So in order to avoid that, we want to start small, right? We don't want to overcommit. So really sit down and think, how much can I realistically afford to invest for the next 6 to 12 months consistently? Now, that might mean starting off with a smaller number than you would like. So let's say ideally you want to invest $100 per month. That's $100 per week. Excuse me, that's $400 per month. That might be a lot. So instead of starting off with that lofty goal, maybe scale it back and let's start off with 25 or $50 per week. And then you can see how that goes. Is it comfortable? Are you able to commit to it? Is it negatively impacting your finances and your other responsibilities? And that is when you will figure out whether or not you can afford to invest more, or should you scale back and invest less. Truthfully, you are better off starting off with a smaller amount. So that way, if you can commit to this new number for a 6 month, 12-month period, then you can increase, because now you know and you have the proof that you were able to comfortably invest those funds. Now, I have had some clients who will start investing more, and as it becomes unaffordable, they will then scale back how much they are investing. Now, that's okay too, but the whole premise is we're trying to avoid having to sell the investments because we are short on our other financial responsibilities, right? So, either way is a great approach. Just again, do what's going to be good for you, but most importantly, the key word is find a number that's realistic. And then you can increase and scale. Now, the second thing you are going to want to do before you start is to figure out what account is the best one for you in this season. So maybe it is starting a 401k with your employer. Now, that tends to be the easiest way to begin investing, but also there is a financial benefit in that most employers will do a contribution to your account. So, but again, to receive that contribution, you have to make a contribution as well. But again, this is going to be a way for you to get free money from your employer that's going to contribute to your retirement. Now, when it comes to the 401k, again, you will have to determine how much you can afford to contribute. And with these plans, it tends to be a percentage of your salary. So maybe you will select 1%. Now, 1% in itself may not be a lot, but every dollar you can put away now is going to help pay future you. And then hopefully that 1% won't negatively impact your bring home pay to where you feel it a whole lot, right? That's why I recommend starting off with 1%. Now, if you can afford to do more, by all means, go right ahead. But ideally, you want to max out your contribution to receive the maximum employer match. So every employer has their own calculation or metric of how they determine how much they're going to match. Some will say they'll match 3% up to a certain dollar amount. Again, every company is different, but you want to get the most that you can from your employer. But that will mean you need to increase your contribution usually. So again, you want to find a healthy balance of starting small, and if you can increase your contribution, you can so do that. That is the other great thing about 401ks. You can change how much you are contributing throughout the year. It's not a set number for the entire 12 months. You can literally change it month to month. Most times you can log on to your online account, go into the portal, make your percentages changes, and then so on and so forth. You can also pause your contributions as well. But just know if you are not contributing, there won't be an employer match. So think about that. Your other option, of course, are the traditional IRA or a Roth IRA. But of course, you want to talk to your accountant to figure out which one is the best fit for you. And last but not least, maybe you want to open a 529 to start contributing to your child or grandchild's college education. Now, regardless of what account you go with, the biggest thing you want to pay attention to is one, do they charge a lot of fees? And if they do charge fees, how much are those fees? Are they monthly? Are they annually? Because those fees are going to come out of your pocket, right? Also, how easy is it to access your account and make your contributions? Now, most companies have a website, most have an app. They tend to make it pretty easy, but again, not every app is different. Some are more user friendly than others. And the other thing you want to pay attention to is the customer service aspect. If you are someone who likes the idea of being able to talk someone or to physically go into a location to speak to someone, that will kind of dictate also the kind of company you end up opening an account with. For example, if you were to go with a Robinhood, right, they don't have a physical location. I don't believe you can call anyone, but you are able to message and email people to answer your questions. Company like Fidelity, while Fidelity does have their online presence, they have great customer service that you can actually call someone. They also have brick and mortar locations. So you can actually go into a Fidelity branch and speak to someone. So it all just comes down to your personal preference and how you like to do business. And that should dictate how you decide which company to go with. Now, the other thing you want to keep in mind as you embark on this investing journey is what is your risk tolerance? So, risk tolerance basically means how much risk are you willing to take and how much risk are you willing or are you able to handle, right? So, some investments are more risky than others. And within those investments or asset classes, you also have different levels of risk as well. So, for example, when we think of different asset types, things like cryptocurrency are super volatile. And so there is a lot of risk when it comes to investing in crypto. But the general rule of thumb in investing is high risk, high return. Doesn't always hold true, but that is a general premise that people tend to have. And so if you are someone who doesn't mind taking a lot of risk, and you also don't mind watching your investments increase and decrease significantly day to day, then right, crypto could be a great way for you to invest. But if you don't like risk and you don't like seeing volatility, then cryptocurrency really isn't something you should invest in. So when it comes to picking your investments, your risk tolerance is going to matter. So, for example, when it comes to investing in the stock market, you also have different degrees of risk there as well. So, you have a company that's been around for, let's say, 25 years, those tend to be more stable. Those stocks don't tend to increase or decrease quickly over a short period of time. But you will have other companies, maybe an IPO or companies that have not been around as long, where you could see huge fluctuations in their stock price. So again, depending upon your risk tolerance will dictate what kind of companies you invest in, what kind of industries you invest in, so on and so forth. But it is super important to understand that piece so that will help you understand where you should or should not invest. Now, even if you are risk averse and you don't like the idea of risk, you could also still have a small portion of your portfolio where you may take some riskier chances with your investment. So let's say out of 100%, you can dedicate 5% of your portfolio to being okay with investing in high risk assets. But again, you don't have to, but that is just one approach you could have to investing. And so that will kind of help you break out of the mold you're trying to put yourself in and is at a little bit of risk to see how it goes. Now, you may do that and say, I don't like it, and then divest, no harm, no foul. But sometimes branching out of your comfort zone can help you with your investments, and you might get things that give you a nice ROI. Now, the other thing when it comes to your risk tolerance, that also should determine how often you check your portfolio as well. If you are someone who doesn't like to see these variations and fluctuations day to day, you should not be looking at your portfolio every day because it is going to drive you nuts, right? So maybe your general cadence is you will check your account maybe once a month or once a quarter. Now, if you don't mind seeing those daily fluctuations and that's not going to cause you anxiety, you can check your account every day if you so choose and if you so have the time to do so. But regardless of your risk tolerance, you should be looking at your accounts on a regular basis. Now, what does that look like? It could look different for everyone. It could be weekly, it could be monthly, it could be quarterly. But what I like to recommend at a bare minimum, you should be checking on your accounts at least once a quarter. And if it's hard for you to recall doing that, I recommend putting in a calendar reminder and just set it to go off once every 3 months. So it could be, the first weekend of each quarter. That is the time for you to check your investment. So you have April, May, excuse me, April, May, June. So maybe you already checked April. So come early July, you will then check your portfolio again. Now, if you are able to do so, checking your accounts monthly is actually a great cadence, in my opinion. But again, at a bare minimum, checking it quarterly. Now, it sounds even crazy. I have to say that. You will be surprised at how many people have investments and they don't even look at it. So I remember 2 or 3 years ago, I did a couple of focus groups trying to understand. So let me pause. So my target audience is women. I tend to work, I don't mind working with men, nothing wrong with men, love you guys. But my target client is women. That is who I primarily work with. And so in these focus groups, I was trying to figure out what their pain points were about investing, where they are when it comes to investing, what are their pain points, so on and so forth. And you would be surprised at how many of those women mention that they don't check their investments. And many of them, like they're actively investing, whether it's through their 401k, they have an IRA. So they're putting the money away, they're doing the work, but they just have no interest in checking the money. Now, some of them said, well, I'm scared to check it. I'm worried about if oh no. Are you guys still here? Hopefully, my computer just did something weird. So some of them were just avoiding looking at their portfolio out of fear that it's going to be bad. So they figured if they do like the ostrich thing, where if I put my head in the sand and ignore it, that means nothing else is really happening, so it should be okay. So there's that. Others said, well, if I look at it, I don't know what I'm looking at. I just see numbers on a screen. I'm not really sure if it's good, if it's doing well, or if it's not. I truthfully have no idea. Right. And others would say, well, my husband takes care of that. Right. And so my response to all of these women were as follows. So, one, when it comes to the fact that your husband handles the investments and he handles that stuff, totally get that. I have a husband too. But I also I'm a believer of that iron sharpens iron. And the more that you can learn and contribute to the conversation, you guys can learn from each other and bounce ideas off of each other. I know my husband and I do that all the time. We talk about investing. He has one perspective, I have another, and we are just always learning from each other and bouncing ideas off of each other. And it really makes for a great conversation. But more importantly, it's helping us both grow as investors, right? So the other individuals who are just kind of putting their head in the sand, that's a tough one, right? Because they're doing the work in that they're putting the money away, right? That's already half the battle. So I definitely love them for that. But you also can't fix what you don't acknowledge. And what I mean by that is if you have money in your 401k and you have certain investments and some of them are doing poorly, like really, really poorly for a long period of time, you have no idea, right? Because you're not looking at it. So you are making these bad investments when you could pivot and invest your money somewhere else. And that's the other reason why it's so important to check on your investments. And whatever cadence you so choose, is that by checking, you can see if any changes need to be made. So when you think about investments, so some of them they will make money, some of them will lose money, and some things are seasonal and some things are just the overall market. But you will sometimes have investments that they're just bad. Like they were good at one point, or maybe you were guessing, but at this point, it is a bad investment. It's been losing money for a long time. And so now you should be divesting out of it, right? So there's that. But you have no idea that's going on because you're not even looking at it, right? And so, kind of going back to what I mentioned before about the stock market, people panic selling. Selling in itself isn't an issue, right? People sell investments all of the time, but it's the why you're selling is the issue at hand. If you are just selling because the market was down for a couple of weeks and you're just panicking, that's not a good reason to sell. But if you are selling because you're looking at your portfolio, you know what your goals are, and this investment no longer serves you, and so it's time to sell, or it's made enough money for you and you want to just get out now, that's okay. There's nothing wrong with selling, but it's the why. What is the reason? Do you have a good reason? Do you know why you're selling, or are you selling just because the sky is falling? Right. And so going back to the people who are ignoring their investments, you have no idea what's going on. So you don't know if you should buy more or sell because you're not even looking at it. Right. And so this is where checking on your investments on a regular basis is really important. And then to go to the other person, that other people who are talking in these focus groups is, well, when I open my account, I don't know what I'm even looking at. And so my response to that is, I get it. but you can't sit in the ignorance, right? This is your hard-earned money that you're putting away every single pay period or every single month, and you're putting this money away religiously. You have to understand what's going on in there. Now, do you need to know every single piece and every single financial term? And do you need to know charts? No, you can if you want, but you need to know at least the bare minimum. You need to at least understand, are these investments making me money? Which ones are making me money? Which ones are losing me money? Why did I pick these investments in the first place, right? So that's another thing. During this focus group, well, I did a few focus groups a couple of years ago, and some people, they were like, I don't even know why I had this in my portfolio. I don't know how I picked this. I don't know why I picked this, but it's here. I don't know why. And that's a scary thing to hear, right? Now, I get it. Sometimes you are in the default fund in your 401k because you didn't pick anything. Sometimes you're picking things randomly. You're like, eeny, meeny, miny, mo. I know that sounds crazy, but people do this, right? Or you're taking advice from a coworker or from a friend or whomever. And so you picked these things, but you don't really know why you picked them. And so this is why it is important to really begin learning so you can be more educated as you make future decisions, right? You can't really explain what you did before. That's fine. You are in a place of no not being ignorant anymore, right? You're beginning to learn, or hopefully you're beginning to learn, and now it's time to pay attention to your finances or your investments. So now you have to figure out, well, let me start learning the basics. That means basic terminology, nothing fancy, but again, the basics, right? So like dividends, um dividend yield, 52-week range, some of the basic terminology. I have a book actually, so if you want to learn more, I'll try to recall to put a link down below. I'm not good at putting the additional links in this description box, but I will try to put a link to my ebook. It's called Stock Market Investing for Beginners. So in this ebook, I do break down investing in a way that's very simple and very easy to understand. I explain investing terminologies. I also teach you how to begin to create your own investor checklist. So I will hopefully recall to put a link down below. If not, I do have a link to that ebook in my link in bio over on Instagram, TikTok, and Facebook. Now, my socials are listed in the caption down below. I definitely know that is there. So feel free to check that out. But again, I'll try to put the link to the ebook down below as well. So you want to learn the bare boned concepts of investing. So that way you can begin to understand what's going on, right? When I think about investing, I always compare it to going for a job. So when you are looking to apply for a job, no one's handing you the job. They're not. They're putting you through a vetting process. So they will take your application, they'll look at your resume, they may put you through a few rounds of interviews, they will ask for references, right? Background checks, credit checks, and they're checking all these boxes for you to go through this process to see, do you meet all of these requirements? And once you've checked every single box, then they offer you the job, right? That's pretty much for the most part how most job offers are given. So you as an investor need to consider doing something very similar. How are you vetting these companies or index funds or mutual funds before you invest in them? Are you checking off boxes? So this is the investor checklist that I'm talking about. So as an investor, when you're looking to buy a stock or even any investment, truthfully, there should be like 3 to 5 things you're looking for to help you dictate whether you do or don't invest in this thing. Now, what those metrics are will be different from person to person, right? What's important to you is different than what's important to me. But you should have something you're using. Now, it doesn't have to be a formal checklist like on a piece of paper. It could be a mental checklist, but it has to be something that you're kind of walking through to understand whether you should invest in this thing or not. So, for example, it could be, do they pay dividends? Yes or no, right? That could be a requirement you have as an investor. Well, what is the stock price today? Is it cheap? Is it expensive? Is it kind of somewhere in the middle? That could be something you care about as well. I know for myself personally, I do look at the balance sheet of a company to see how much cash do they have on hand. because for me, that's important to me as an investor. So there's so many things you can look at to kind of dictate whether or not you invest in a company. But the first thing you should be looking at, do you understand what they do, what they sell, what they offer? Never invest in anything you do not understand. So that should always be your general rule of thumb. And once you cross that threshold, then you kind of go for your other things that are in your checklist. Super, super, super important. We have to move away from guessing and making more educated decisions. Now, are you going to have all of the answers? No. Will you still pick some bad investments? Absolutely. But I'd rather see you invest in things from a place of understanding versus from a place of hoping, wishing, and guessing. What is happening here? I don't know. Oh, I know what's happening. I'm touching the mouse pad here. Hold on, guys. Let me fix this. Okay, hopefully I'm still here. Yeah. Okay, we're good. So you want to be more proactive, come from a place of education versus a place of hoping for the best. And too many people are hoping for the best. So that is the whole reason why I have my YouTube channel where I'm trying to educate more people. I have various products like my ebook. I also do an investment challenge throughout the year. So if you're not giving me a follow on Instagram or TikTok, feel free to do that. So you will see when my new programs do launch. Now, in regards to my ebook, that's also available in my link in bio. It is a great way to start your investment journey. And it's going to help you just learn the basics so you can begin to feel more educated as you make future investment decisions. So that is it for today's live, guys. If you have any questions and you are watching the replay, feel free to put them in the comment section down below. I will come back and address your questions. Or if it's a great question, I can actually create a separate live and address your question there. So definitely feel free to leave your comments down below. And please, please, please just know there's no such thing as a stupid question. And I promise you, whatever question you have, someone else is probably has the same exact question. Trust me on this one. So that being said, have a great night, guys. And I'll talk to all of you guys soon. Take care.